Diversification in the financial investing world is not just about having different stocks. It goes deeper than that. What it's about is having different stocks that don't move together. It's about having stocks that zig while having other stocks that zag. It's about having some stocks that are cyclical or economically sensitive, so they do well when the economy does well. And then there are stocks that are defensive, and they shine when the economy is not so hot or when the economy is cold or in a recession. And you have different kinds of stocks that do well over different periods of time, with the expectation that over time, they should all do pretty well. Now, that in reality doesn't always happen, which is why we diversify. Diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. It's a strategy that manages risk, not a strategy to boost returns. If all of your investments are up at the same time, you're not properly diversified. What you need to do is you need to own stocks that do well at different times. This helps moderate the performance in your portfolio. You want a portfolio that goes up like that? My hand is so high, it's not even in the screen. Or a portfolio that plunges. My hand is so low, it's not even in the screen. Owning 10 or 20 stocks does not mean you're diversified if all of the stocks are correlated, meaning moving up and down together. Lesson of the day.